Hi friends, very good evening all of you. So after holy period of Baishaki, Vishu, Tamil New Year, so we are starting our accounting standards revision preparation. Thanks to ICI for conducting this. And today we are going to discuss, a last minute revision, a quick revision of accounting standards from paper 5, that is advanced accounting. Okay. So as you know, if you look at the weightage, ICI said the weightage of this particular topic, what we are going to discuss, the accounting standards as per ICI weightage sheet is around 25 to 30%. So in your paper, you can see 25 to 30 marks from accounting standards. Worst case scenario, it could be 16 to 20. Best case scenario, it could be 40. And if you include amalgamation as one accounting standard, AS14, as a part of accounting standard, if you look at it, the weightage of accounting standards might go up to 50 also, might go up to 45, 50. But there are three standards in group 1 and group 2 put together, which we do not consider just as a standard, that is a separate chapter for us. For example, cash flow statement. If you look at CA Intermediate Group 1, in paper 1, we have, I think, unit 2 of chapter 4 is cash flow statement. So we do not consider that to be just a standard. We'll consider that to be a chapter. And another particular area is investment accounting. And at another area is this accounting for amalgamations. And you have AS21 also, which is consolidated financial statements, but that is not given as a part of the standard, that is given in the chapter itself. So basically, there are two areas in CA Intermediate Group 2 Advanced Accounting, which are not standards, which are actually standards, but a student should consider that to be a full-fledged chapter, not just as a standard, that is Accounting Standard 14 and Accounting Standard 21. So today we are going to cover maximum whatever best we can do. I'll try to cover maximum concepts and problems. Since this is a revision program, I assume, I do not know whether it is a correct assumption or a wrong assumption. I assume that you have, some basic understanding of, need not be an expert level understanding. I assume you to have a basic understanding of accounting standards, maybe 50% or 40% of whatever is there in the book. If you know 40%, 50%, it is enough. I'm not expecting you to have 100% of knowledge in accounting standards. If you have, why will you come to class? Okay, better you'll do some other things. So now tell me, how much of, what percentage of accounting standards do you think you know? Your own perception, your own evaluation. So type the percentage in the chat so that I understand. 20, 30, Leo is saying 20, someone is saying 0.3, 10%, 30, 40, 50, Maria 60, very good. Another 20, 20, 10. Oh, some guy is saying 90%. Okay. 65, 80. Okay, I really appreciate 70, 30, 30. Okay, 60, 70. Last few standards little. Okay, Amrita is saying, okay, very good. Super. Super. Everybody is saying, their own perception, but ICI will have a different perception on us. So we have to respect ICI. Chalo, anyway, this is just to make you active, okay? Just to make you active. So there is no, there is no purpose of our percentage, what we know. ICI finally is the final authority, isn't it? So in the syllabus, we have AS4, AS5, AS7, AS9, 14, 17, 18, 19, 20, 22, 24, 26, 29. Okay, in this 14 will not cover because that is altogether a different category. 17, 18, 19, if you look at it, these are new additions in the syllabus from CA final level. Leases has more connection with financial management because we do use a lot of discounting factors, present value factors. And 24, 18, these are two standards, completely theory. There is no problem. You cannot see any questions on these kind of, maybe theoretical questions will be there, but you cannot see any numerical problem in this standards, 18 and 22 to some extent. In 22, problems are also there. 18 and 24, no problems. And favorite problems from exam point of view, favorite standards from exam point of view are AS 7, 9, 26, 29, 19. Okay, I'm not saying remaining are not important, but these are hotcakes. If you look at it, 7 and 9 almost deal with same. In new generation accounting standards, you call it IFRS or Ind AS, they are same. 7 and 9 together is one standard that is called revenue recognition. Contracts from customers, revenue recognition. Everything is a contract. Even if you are selling good, even if you are selling any service, that is also a contract. So basically 7 and 9 are same. 7 and 9 are same. So today some students are asking, deal with this standard, deal with this standard. I'm recollecting that in Sri Ram Navami, there will be one orchestra, one mic will be given to one singer, and people will say, sing this song, sing that song, and all. Okay, so there are 140 plus students. I might not be able to honor your standard because what is easy for you could be difficult for others. So as a faculty, I do have the experience. Okay, I'll go with my flow. If you need any other standard, we have many free resources. Even Sikasa is giving you many free resources. I am giving you many free resources. You are free to use them any day. So today, in the name of God, please don't ask me do with this standard first, to do with this standard first, because if I am biased, I'm not justifying the remaining 140 students. Okay, so please do understand. I'm sorry for that. So the popular standard is this one. Revenue recognition, multiple questions came. We'll not spend more time on theory. We'll spend to the extent, the least time possible on the theory. We'll solve more problems. And today I'll give you one very good news. That is, I have worked a lot on compiling something you can see on the screen. This is the accounting standards notes I have prepared covering last 15-year question papers. So this, if you look at it, this is running into 203 pages. Okay. So today we'll start with that. Okay. So accounting standard 4, contingencies and events occurring after balance sheet date. I'll make this 200 pages document available to all of you. It consists of theory, complete concepts, and it contains problems and solutions, including solutions I have given. Because if I am unable to teach everything, at least you will have question and answer with you. Okay, so this considers all the standards of group 200 pages, including ICI study material, all questions and answers, plus last 10-15 years question papers, all the important models from RTP and all, everything is covered here. If you look at it, accounting standard 4, what is accounting standard 4, what it deals with, contingencies and events occurring after balance sheet date, all this blah, blah, blah is there. Definitions are given. What is a contingency? What is event occurring after balance sheet date? We are not going into the details. 2 types of events they are saying. Okay, those that provide further evidence of conditions existed at the balance sheet. So this is category A event, and then there is category B event. Can you tell me quickly without wasting time? Is there any nickname for this events, those which provide further evidence of conditions that existed at the balance sheet date? Is there any nickname for this? What do we call this? We call this an adjusting event. Excellent. Okay, so obviously the second one is a non-adjusting event. Those which are indicative of conditions that arose subsequent to the balance sheet date, these are non-adjusting events. So the standard is whole about, shall I adjust my financial statements, or adjustment is not required, only disclosure is required. One very, very, very important note. Previously, if there are any events that are not adjusting events, they are not adjusting events, but the severity, the volume, the quantity, amount involved, they are material in nature. So a disclosure is required. Previously, disclosure was in board of directors report. Now the disclosure is required in financial statements, notes to account. This is because of a change to accounting standards in lines with IFRS. So this is a recent change. If you are looking at old study material or old practice manual or old questions and answers published by ICI or any other author, you might see a disclosure in the report of approving authority or board of directors report. A disclosure is required in directors report. This was old sentence. Now we need to write disclosure in notes to accounts is required. Disclosure in financial statements is required. This is a change and very important change. This is a change and very important change. Other than that, I don't see anything that is great in this. So adjusting events they have given, non-adjusting events they have given, and few problems are there. We'll see important problems and then we'll skip and we'll go to next standard. But one very important thing I want to tell you before that, if you look at this, compendium of material, I have more than probably 200, 250 problems in this. So one standard, I remember 15, 20 questions and answers are there. Let me have a look at it. If you look at this 2, 3, 4, 5, 6, 7, 15, 13, 14, 15, 16, 17. So in one standard, there are 17 problems and solutions. But when you start reading it, you'll get it out. But Pavan sir, in the question, they mentioned 2015, 2013, 2011, 2012. Is it relevant, Pavan sir? This is a problem which was 10 years old. Beta, I'll tell you, in accounting, costing, financial management, there are questions which are 40 years old, If you look at certain textbooks like Vasistha and Saxena, these are the classic books. Okay, Kanna Pandey, Ahuja Arora, then Khan and, Jain and Narang. So this kind of books, if you get Basu and Dasu, okay, R.L. Gupta Radhaswamy, this kind of textbook, if we look now, there will be one beautiful problem. Under that you see CA intermediate or CA final, 1972, you will be scared. Old problem, is it relevant now? The answer is yes, they are relevant. What any author who is, writing a book, what they do is simply they'll change this 2013 to 2022 or 2023 so that it becomes a hot problem for you. But trust me, if there is a problem in this particular book, and if the date is old, close your eyes, read the question, read the solution, they are relevant. If there is any amendment or if there is any change, I might have changed the answer 99.9%. So please don't go with year, even if it says 2009, 2015, 2017, 2022, 2013, we are okay. So are we agreeing on that? Are we agreeing year is not relevant? The concept is 100% relevant for your exam. Are we agreeing on that? Yes, bolo, then we'll move forward. Okay. So can anyone turn on the mic and read this question number 17, please? Or after someone is asking, where will I get this study notes? After this call, speak with our text Sikasa office bearers, they'll give it to you. They'll give a free copy, okay? Or you can get it in our website and social media also. Not a big thing. So is there anyone who's ready to read this problem? If no one is there, Sai Kripa, you read this. If someone is there, please read this problem. Don't waste time.
Shall I read, sir? Naveen.
Yes, please.
State with reasons how the following events would be dealt within financial statements of Pradeep Limited for the year ended 31st March 2013. An agreement to sell a land for rupees 30 lakhs to another company was entered on March 2013. The value of land is shown at rupees 20 lakhs in the balance sheet as on 31st March 2012. However, the sale deed was registered on 15th April 2013.
So if you look at the facts of the case, one second. If you look at the facts of the case, 1st March, they entered into an agreement to sell. 1st March, but registration document, they were able to register the property on 15th April. So 1st March, you have entered into an agreement, gentleman agreement in writing. I will sell my property to you for 30 lakhs. On 1st March, agreement of sale is entered into. But the buyer and seller, they have to go to sub-registrar office to get the property registered. That happened on 15th April. So now on 31st March, Will you show this 20 lakhs worth land in your balance sheet? Or do you think, Pawan sir, sale is over, asset should be de-recognized and pass the journal entry, Pawan sir, pass the journal entry as if the land is sold. So do you show land in your balance sheet as an asset or it is sold? Just tell me, is it an asset in your books or is it sold on 31st March? Is it asset in your books or is it sold? Okay, so I'm getting different answers. Correct answer should be the asset is sold. You cannot show this as an asset in your books on 31st March. The asset is sold. If there is a profit, you can recognize the profit also. You understand? So the transaction is actually entered into on 1st March. The transaction is actually entered into on 1st March. On 15th April, registration happened. That is additional evidence that is confirming an event that is already existing on the balance sheet date. What is the event that is existing on the balance sheet date? Sale deed. Sale deed. It is already there. So this is point number one. Point number two. This is a bouncer. The negotiation with another company for acquisition of its business started on 2nd February. Oh my God. We get bold. And Pradeep Limited invested 40 lakhs on 12th April 2013. So here what happened? On 2nd February, negotiation started. On 12th April, you have invested money in the other company to take over. Acquisition of business. So on 31st March, what is the status? On 31st March. Is it an adjusting event or non-adjusting event? It is an adjusting event or non-adjusting event. Please tell me adjusting event or non-adjusting event. Non-adjusting. Everybody is telling non-adjusting event. Excellent. Because negotiation is not an event. That is not a condition existing on the balance sheet date. For example, March 31st, one person came to your shop and asked, Anna, how much is this jeans? You said it is 2000. He said, can you give it for 1500? You said no. Then April 5th, he came and he again asked, Anna, can you give it for 1500? No, chalo, because you came last time also, I'll give it to you for 1700. So you sold it. But 31st March, whatever the negotiation started, that is not any event or transaction existing on the balance sheet date. So you have to record it on April 4th, whenever that 1700 is negotiated and paid. That's it. Even if that 1700 doesn't come into your bank account, still you can recognize as a credit sale. That is a different story. But the second one is a trap. So first one is an adjusting event. Second one is a non-adjusting event. Look here. In the given case, the sale of movable property was carried out before the closure of books of account. This is clearly an event occurring after the balance sheet date, but agreement to sell was effected on 1st March. It is before the balance sheet date. Agreement to sell was effected. Registration on 15th April simply provides additional information relating to the conditions existing. Therefore, adjustment to assets for sale of land is necessary in the financial statements for the year ended. So adjustment to assets for sale of land is necessary. This is an adjusting event. The second one, applying provisions of the standard which clearly state that disclosure should be made in the report of the approving authority. Oh my God. Old answer. What did I say? Report of approving authority. If this kind of answers are there, now you need to say in notes to accounts. That means financial statements, not in board report. Disclosure should be made in notes to accounts. That means disclosure in financial statements is required. Okay, you can highlight this. Okay, you can write if you want. Note, earlier the disclosures were made in the report of approving authority, or commonly known as director's report. Now disclosure should be made in financial statements. Even if you look at ICI latest answers, they are mentioning financial statements. Okay, so this is one question. So randomly we'll take 1, 2 more questions and then we'll see. So problem number 15. Can someone read problem number 15, please? Who's reading it?
Cashier of, shall I read, sir?
Yes.
Cashier of A1 Limited embezzled cash amounting to rupees 6 lakhs during March 2012. However, same comes to notice of company management during April 2012 only. Financial statements of the company is not yet approved by the board of directors of the company. With the help of provisions of AS4, contingencies and events occurring after the balance sheet date, decide whether the embezzlement of cash should be adjusted in the books of accounts for the year ended 31st March 2012. What will be your reply if embezzlement of cash comes to notice of the company management only after approval of the financial statements by the board of directors of the company?
Okay, so two beautiful questions. One question with the two different situations. So first, forget about second situation. Tell me what is first situation? Is it an adjusting event or a non-adjusting event? Yes, very good. This is an adjusting event. Actually, this problem has some connection with accounting standard 5 also. This problem has some connection with accounting standard 5 also. In old CA final material, they mentioned that this is an extraordinary event, but actually it is not. Actually, it is not. So let me give you the correct answer relevant for today. This is part 1. Okay. In part 1, when there is an embezzlement of cash, so there is a theft, 6 lakh rupees. Okay. Before the balance sheet is approved by board of directors, it came to the notice of management. Okay, then it is an adjusting event. So you'll go back to the balance sheet and you'll write this 6 lakhs as loss. Okay, cash loss you'll write. That is point number 1. Now let us read the old answer, what they said. I'll try to modify it and give it to you. As per para 13 of AS4, assets and liability should be adjusted for events occurring after the balance sheet date that provide additional evidence to assist the estimation of amounts relating to conditions existing at the balance sheet date. Point number 1. Point number 2. The theft by cashier 6 lakhs was detected after the balance sheet date, but before the approval of financial statements. But it is an additional information materially affecting determination of cash amount relating to conditions existing on the balance sheet date. Balance sheet date condition is cash. Theft is also existing on the balance sheet date. Therefore, it is necessary to make adjustment in the financial statements of the company. That means what they are saying, this is an adjusting event. This is an adjusting event. Okay, up to this, there is no problem. The answer is right. But I think ICI has messed it in the second para, if I remember correctly. If embezzlement of cash comes to the notice of company management only after approval of financial statements by board of directors, then the treatment will be done as per the provisions of AS5, this being extraordinary item. I don't think this is an extraordinary item. Now, this is not an extraordinary item. This is an ordinary item. So should be disclosed in the statement of profit and loss as a part for the year ending March 2013. Where are we? We are near March 2012. Okay. Now, this being an extraordinary item should be disclosed in the statement of profit and loss as a part of P&L. Yes, agreed. For the year ending March 2013, agreed. So this is right. It should be. This is okay, but this is not an extraordinary item. This is now an ordinary item. Okay. Previously in India, before implementing IFRS in 2017, previously Everything can be exceptional item, everything can be extraordinary item. But now remember, as per accounting standard 5, extraordinary items, this word, this phrase, extraordinary items shall be given only to two things. One, natural calamities. You call it fire accident, you call it, tsunami, you call it anything like this, disasters, natural calamities and disasters. Point number one. Point number two, if there is any government grant which is actually revoked and you are refunding a government grant, or government is attaching your property, government action to take some of your assets, that can be extraordinary. As per the accounting standards, only these two things are extraordinary now. So anything, net realizable value of inventory is lower than the cost, all these bakwas, a provision is created, provision is adjusted, all these are ordinary items. This is not an extraordinary item. Of course, the accounting will be done for March 2013 only, because there is no chance that you can do accounting in March 2012, because the balance sheet is prepared, balance sheet is approved by board of directors, and probably that might have been circulated in AGM also. So only next year you'll be able to do this. That's all. You understand? That's okay. So this is this problem. Please be careful. Okay. And before circulating this material to the students, I'll try to revise all the answers once again. Don't worry. Okay. So we'll see randomly 1-2 more questions and then we'll see. In the exam, Deepak, you have to write that this loss will be accounted for 31st March 2013. If it comes to my knowledge, before board of directors approved financial statements, I would have reported that in 31st March 2012 balance sheet. If it comes to my notice after finalization of financial statements and after approval of board of directors, it will be accounted in 2013. That's it. Clear? Okay, very good. Again, cash theft, all repeat will be there. Company sale of property, this also we have done. Sale of property, 2 questions came so far. And the other model, 2 questions came. Assets in the factory, 5 days after the year end of accounts, loss is estimated 10 crores. A fire accident happened. Fire accident happened. So can you read this question, please? Naveen, read question number 9.
Yes, sir. A major fire has damaged the assets in a factory of a limited company on 5th April, 5 days after the year end and the closure of accounts. The loss is estimated at rupees 10 crores, out of which 7 crores will be recoverable from the insurers. Explain briefly how the loss should be treated in the final accounts for the previous year. Again, this has AS4, AS5 both. Ordinary event, extraordinary event, you need to tell. Event occurring after balance sheet or, adjusting event, non-adjusting event. Again, you need to tell. So now, guys, do you think this is an adjusting event or non-adjusting event? Do you have any information in your hand on the balance sheet date that there will be fire accident after 5 days? You do not know. So it is a non-adjusting event clearly. Plus, because it is fire accident, it is an extraordinary item. It should be disclosed separately. So look here, the loss due to breakout of fire is an example of event occurring after the balance sheet date. The event being in the nature of a fire which is unpredictable does not relate to conditions existing at the balance sheet date. If it has not affected the financial position as on the date of the balance sheet, therefore requires no specific adjustment in financial statements. Oh my God. No specific adjustment required. But tell me one thing. Can these things influence going concern ability of the entity? Yes. But having said that, out of 10 crores of loss, 7 crores is recoverable from insurer. I don't think there is a going concern problem because 70% of the loss is recovered. You understand? So if you think going concern ability of the firm is affected, you will have to disclose that also. But
that we will not discuss here, because even going concern assumption and how the disclosures and all are done completely changed because of IFRS. In old accounting, what they do is, in old accounting, or maybe in CA intermediate, even now we are following this only. If there is any, impact on the going concern ability, that should be disclosed. This is what our answer is. In reality, if you are following any Ind AS or IFRS, if this situation is happening in practical world today, you will not just look at the going concern impact. If it is no more a going concern, you will redraft the whole balance sheet based on liquidation. So there are two types of, there are two bases for preparation of financial statements. One is going concern basis, one is liquidation basis. In going concern, what we do is we follow regular accounting principles. Like, for example, in case of a fixed asset, cost less depreciation. In case of current assets, cost or NRV, whichever is lower. So like this we follow. Okay. But when you are following liquidation basis accounting, you will not value your assets at cost less depreciation. You will value it at its realizable value. Assets have to be recorded at realizable value. Liabilities have to be recorded at redemption value. It is altogether a different story. That is the reason we are not entering into that zone. So fire accident happened on 5th April. There is no condition existing on the balance sheet date. This is a new condition. So there is no specific accounting required in the financial statements for the previous year. That's all. Okay. So here they have given. However, paragraph 8.6 of AS4 states that disclosure is generally made of events occurring after the balance sheet date. That is, in the subsequent periods that represent usual changes affect the existence or substratum of the enterprise after the balance sheet date. In the given case, the amount of loss of assets in factory is material. Obviously, it is material. So it can be disclosed. Where will you disclose it? Previously in board report. Now it is in financial statement. That's all. So we'll see one more problem and then we'll jump to next problem. Deep, can you read this problem? Problem number 8.
Yes, sir. I'll do, sir. I'll do.
Yes, yes.
MEC Limited could not recover an amount of rupees 8 lakhs from a debtor. The company is aware that the debtor is in great financial difficulty. The accounts of the company for the year ended 31st March 2011 were finalized by making provisions at 25% of the amount due from the debtor. In May 2011, the debtor bankrupt and nothing is irrecoverable from him. Do you advise the company to provide for the entire loss of 8 lakhs in the books of accounts for the year ended 31st March 2011?
What is the provision to be carried on 31/3/2011? Guys, tell me what is the provision required on 31/3/2011? This is a common question in ICI exams. Debtor becoming bankrupt. Someone is saying provision 0. Hey, what is provision 0? 100% provision is required. Why 0? Total 8 lakhs should be recognized as a loss. So an allowance to be made. In latest accounting standards, we call it allowance. In old accounting standards, which is CA intermediate level, we call it a provision. A provision for non-recoverable. Okay, new language is an allowance for non-recoverable. You write provision, that is still fine. Okay, so this is a common question in ICI exams. What is this question? A debtor is there. He is having financial difficulties before balance sheet date. You have created a provision. After balance sheet date, he has become bankrupt. 100% provision should be created because it is an event existing. It is a condition existing on the balance sheet date, and the bankruptcy of the debtor is an additional evidence, additional information. That's it. Additional information. Okay. Now we'll quickly move to next standard 5. The title of the standard itself is big. Net profit or loss for the period, prior period items, changes in accounting policies. Can you tell me how many parts are there in this standard? This standard deals with how many parts? This standard deals with how many parts? 4, 5, 3, 8. Previously, we have seen AS4 deals with the 2 parts, contingencies Events occurring after balance sheet date. So predominantly it is events occurring after balance sheet date. Contingencies were moved to AS 29. Okay. AS 5 deals with actually six things. Everybody is writing 3, decoding this title of the standard, but it deals with 6 things. Ordinary items, ordinary but exceptional items, extraordinary items, prior period items, changes in accounting policies, changes in accounting estimates. Okay, there are 6 areas here. Now, we need to understand this first. What is ordinary but exceptional item? That means it is a regular item. It is a regular item, but the volume is high. Okay, look here. Look here. Ordinary activities are activities which are undertaken by an enterprise as a part of its business. Sale of goods. Okay, sale of scrap. Rendering of services. Or if you look at any supermarket, okay, they are selling goods and they will sell carry bags also. For carry bag, they are charging, say, for example, 1 rupee, 2 rupees. That is also ordinary activity. Now you cannot say, even if you take school, the best example is school. They will take tuition fee, school fee, but how many other types of fee they collect? Language lab, then karate fees, music class fees, isn't it? All these will be there. Sale of uniform, belt, tie, notebooks, materials, exam fees, then coordination, attendance is not there. So if your attendance is not there, why are they charging penalty for that? Huh? You don't attend classes, but pay 1,000 rupees, you can write exam. That kind of fee is also there. All these are ordinary activities. And they have given here, where income or expense arising out of ordinary activity. So it is basically an ordinary activity, but there is some exceptional size, nature, or incidence. Either in size it is abnormal, or the nature is peculiar, or the incidence is not regular. Then they should be disclosed separately. They should be. I'll tell you one simple thing so that the whole AS5 you can remember on your fingertips. You can keep everything on your fingertips. What is the secret here? Imagine, visualize that you are one financial analyst. You are conducting financial analysis. Someone is writing on my board, disable annotations for others. First delete whatever they have written. Now I have to say, my lord, forgive them. They don't know what they are doing. Okay, chalo, anyway. So an ordinary activity, but if it is peculiar in size, nature, or incidence, you have to disclose it like ordinary but exceptional item. Okay, now visualize yourself as a financial analyst. Now you are looking at the trend of a company, Reliance Industries, 2018, how much of profit they earned, 2019, how much they earned, 2020, how much they earned, 2021, how much they earned, 2022, how much they earned, 2023, how much they earned. So you are trying to do some analysis. Okay, in 1 year, 2019, say for example, loss, profits are abnormally low. So you called the accountant and asked, hey, in this year, all the other years, okay, 10 crores profit, 12 crores profit. So it is going in a trend more or less. Why this year minus 4 crores loss? So you have 10, you have 12, minus 4, 14, 17. 12, 10 is fine, 12 is fine, 14 is fine, 17 is fine. What the hell is this minus 4? In between this analysis. Then he said, sir, fire accident happened, sir. Sir, that year something which is not ordinary has happened, sir. As an analyst, you prefer to know that and you prefer excluding that from your analysis. If that year fire accident has caused you 20 crores of loss, you prefer removing that from your analysis, and your profit would be whatever the loss reported, add back 20 crores loss, add back. Then it comes to say, for example, 14, 12, 13, which is actual business profit. That is the reason to enable a financial analyst to understand whether it is a repetitive item, whether it is an ordinary item, or whether it is not an ordinary item, or this is just an accounting adjustment because of accounting policy or accounting estimate. To give information to him, you need to comply with AS5. Why are we doing with AS5? To give information to a financial analyst who is making some projections. Is this clear? To give information to a financial analyst who's doing some projections. If there is any item which is not ordinary, if there is any item which is just an adjustment, they will not consider that. You understand? They'll remove it. Derivative accounting is completely different. Financial instruments has the three different accounting standards. Derivative accounting would not fall in any of these cases. Derivative accounting is completely different. Someone is asking whether derivative accounts are covered here. No, derivative accounts, there is completely different treatment in accounting standard 11 if it is a foreign currency. If it is, normal investment or for trading, you have different accounting treatments. Even in accounting standards, now in Ind AS and IFRS, there are huge paragraphs which deal with derivatives, but that is out of the scope. Okay, there is nothing about derivatives here in CA intermediate level. So these are the things which probably you would prefer giving as ordinary but exceptional. Ordinary but exceptional. So examples of such ordinary activities which require a separate disclosure in SOPL. Previously, we used to call profit and loss account. Now we are calling it SOPL, statement of profit and loss. Okay, so these are the examples. Then extraordinary items. Read this. Extraordinary items. They are clearly distinct, not expected to recur frequently or regularly. The nature and amount of each extraordinary item should be separately disclosed in SOPL. Whether an event or transaction is clearly distinct from ordinary activities of the enterprise is determined by the nature of the event. Okay, but in general, only, what did I say? Natural calamities, government grants refund, or government attaching the property, these kind of things. Okay, attachment of property of the enterprise by government. Earthquake, fire accident, tsunami, natural calamities, refund of government. That's it. This is what I told you already. Okay, prior period items. What is a prior period item? Which is an income or expense which you have omitted, omission or error. Remember the secret. Frauds are not covered in old generation accounting standards. That means, see, when I say old generation accounting standards, they are AS1 to AS29, what you are studying. Ind AS, in my opinion, it is a new generation standard. IFRS is a global standard. So in old accounting standard, that means whatever you are studying now, frauds are not covered as a prior period item, because they clearly mentioned prior period items are items belonging to the previous year that is coming to current year P&L, which are out of error or out of omission. So, you are one finance head and one youngster, one junior came to you, junior associate came to you and said, sir, sorry, sir, small mistake happened, sir. And you ask, what happened? Sir, 31st March balance sheet, we have recorded inventory, na, sir. There are 8 pages, sir, inventory sheets, 8 pages. Sir. By mistake, we considered only 5 pages, sir. Remaining 3 pages we have not considered, sir. So if it is, in Excel sheet, imagine instead of covering all the items in the column, you have given a wrong formula. Instead of covering 80 items, you covered only 55 items and you did not check the formula. Why this formula changed also, you do not know. Then, sir, mistake happened, sir. We have to add all the items in this column now, sir. We added only 55. Remaining items were not considered, sir. Sorry, sir. This is error. This is a mistake. Two papers are not covered. That is an omission. Then you can treat it as prior period item. Okay. In accounting standard 26, one question is there. In accounting standard 26, problem number 1. That is, a company is using one intangible asset. They have been using it for 7 years. But the accountant forgot charging depreciation. One fine day, you went to conduct audit and you asked him, right, idiot, on this intangible asset, why you are not charging amortization? Why there is no depreciation? Then he asked, sir, on intangible assets also depreciation will be there. Hey, who's that? Keshav, can you please mute your call, Keshav? Okay. So please keep your call in mute. Okay. So what I was telling, in accounting standard 26, I'll show you. Case 26, we'll see problem number 1. This has link with prior period items. Okay, look here. Beautiful question. See a final question, but equally relevant for you also. ABC Limited developed know-how by incurring expenditure of 20 lakhs. They developed. The know-how was used by the company from 1/4/2005. The useful life of the asset is 10 years from the year of commencement of its use. That means it is an intangible asset recognized. They recognized it as an asset. The company has not amortized the asset till 31/3/2012. But when you know that the life is 10 years, you should charge depreciation. No? Now, count and tell me how many years the asset has been used. How many years they have been using the asset? 7 years. So for 7 years, what is depreciation? Tell me. Per annum, what is depreciation? For 7 years, what is depreciation? Very good. Per annum, 2 lakhs depreciation. For 7 years, 14 lakhs depreciation. Now you will understand prior period item properly. This year, how much of depreciation will be charged? 14 lakhs. But out of that 14 lakhs, 2 lakhs is for the current year. 12 lakhs is prior period item because you omitted. You omitted charging depreciation. But the beauty is total 14 lakhs will hit current year P&L only. But logically, last 6 years accumulated P&L is there in the reserves. P&L opening balance P&L is accumulated balance of last all the years. So total 14 lakhs I charge P&L. But 2 lakhs I charge as current year depreciation. Remaining 12 lakhs I'll disclose as a prior period item. Look here. Profit and loss, prior period item 12 lakhs. Current year depreciation 2 lakhs. To intangible asset 14 lakhs. So to which account this depreciation goes? Next entry you will write P&L account debit to depreciation. That means Pavan sir, this went to P&L. This also went to P&L. Total 14 lakhs I'm giving to P&L only. Yes, correct. But this 2 lakhs you are showing as current year depreciation and taking it to P&L. This 12 lakhs you are treating as prior period item. This is accounting for prior period item. So here we are doing prior period item. No, this is what accounting should be. Okay, you understand? This is the one. Okay, now will prior period item form part of current year P&L? Yes, boss, I'll tell you one thing. Okay, this kind of questions, people will give all banana answers. But look here, whether it is ordinary item or ordinary but exceptional item or extraordinary item or prior period item or changes in accounting policy or changes in accounting estimate, everything comes in current year P&L. Everything comes in current year P&L. But if it is change in accounting policy, there will be retrospective accounting. If it is a change in accounting estimate, there is a prospective accounting. Now, this accounting policies is a very dangerous weapon which is used negatively by many entities management. They want to increase profit, they use one accounting policy. They want to decrease profit, they use one accounting policy. So ICAI or the Companies Act or the Ministry of Corporate Affairs or ROC or SEBI or RBI or any other international accounting body or regulatory authority, they do not want companies to manipulate accounts using a weapon called accounting policies. They don't want companies to play with this. What can be done? That is the reason what they said, for the last 10 years, you have been following one accounting policy. Today, if you want to change the accounting policy, change it for the last 10 years also. Huh? Sir, how? Yes. What is the meaning of it, Shut your mouth and don't change accounting policy. So ICAI is telling, if you're changing accounting policy, go to the earliest period reported. Go 10 years back. From there, change everything. Then company management will get a heart attack. Sir, how can I change 10 years retrospectively going back to 2013-14 financial year? It is not possible, sir. Then ICAI will say, then don't change accounting policy. Who asked you to change? No. One day you will tell cost model, one day you will tell revaluation model, one day you will tell FIFO, one day you will tell weighted average cost. Am I a joke to you? ICAI asked, am I a joke to you? No, FIFO to LIFO is not possible, Deepak, because LIFO is no more allowed now. FIFO to weighted average or weighted average to FIFO is possible. LIFO is not allowed now. Globally not allowed. In India also not allowed. In US it is allowed. In UK it is not allowed. Why am I spoiling you with other countries? Anyway, in India it is not allowed. So accounting policy change is intentionally made a little difficult. But Pavan sir, I bought an asset, Pavan sir. I thought I'll be able to use it only for 5 years. Later, I realized the useful life of the asset is 7 years, Pavan sir. It is not 5 years. But genuinely, when I bought the asset, I started using the asset. I never knew that this asset can be used for 7 years. I thought genuinely this asset can be used only for 5 years. So I started charging depreciation based on 5 years, cost minus net realizable value at the end of 5th year divided by economic life. 5 years I used, Pavan sir. But now it has become 7 years. What to do? That is a change in accounting estimate. Okay, all provisions are estimates. Depreciation is estimate. Amortization is estimate. If there is any change in these things, it goes to accounting estimates. Now ICAI is telling, hey, Pavan, listen, you're a very nice guy. There is no window dressing involved in this. You're not using 5 years, 7 years as a weapon. It is a best management estimate. That day you thought 5 years, today you thought 7 years, which is completely acceptable, understandable. Go ahead, do accounting prospectively. Current year onwards, you change it. No problem. This is accounting for accounting estimates. So what is the difference between changes in accounting policy and changes in accounting estimate? Changes in accounting policy, retrospective accounting. Changes in accounting estimate, prospective accounting. That's all. Khatam. Based on this, a method of depreciation now Change in method of depreciation. Pavan sir, previously I was using SLM. Now I'm using WDV. Is it a change in accounting policy? 4 years back, it was considered to be a change in accounting policy. Today, it is a change in accounting estimate. Even method of depreciation, method of amortization, useful life of the asset, realizable value of the asset, whatever is changed, it is an accounting estimate today. It is no more accounting policy. In AS5, one theory question is there. Theory question, give an example of ordinary activities, extraordinary items, prior period items, 2 examples for accounting policy, 2 examples for accounting estimate. This is a question given in CA exams. Those days, when they asked changes in accounting policy, the answer is a change in the depreciation method. But now you cannot write that. I'll show you. I'll show you where it is. Look here. Give 2 examples. Change in accounting policy, change in accounting estimate, extraordinary items, prior period items. Here, change in the method of depreciation for tangible assets was there in ICI book. I changed it because that is no more accounting estimate. That is no more accounting policy. That is an accounting estimate now. So change in method of amortization for intangible asset is still considered to be accounting policy. But strictly speaking, in global accounting, this also is accounting estimate. But in India, you can follow this. Changes in cost formula, FIFO to weighted average method. What are estimates? Change in provision for bad and doubtful debts. Estimated useful life changed. Extraordinary items, loss due to earthquake, fire, strike, attachment of property, examples of prior period item, incorrect depreciation rate, omission of account for income and expenditure. That's it. Okay. So can someone read problem number 11? We'll quickly do 2-3 problems and then we'll move on to next standard.
Can I read? Cost of a machine acquired on 1/4/2009 was rupees 5 lakh. The machine is expected to realize rupees 50,000 at the end of its working life of 10 years. Straight line depreciation of rupees 45,000 per year has been charged up to 2011-12. For and from 2012-13, the company switched over 15% per annum, reducing balance method of depreciation in respect of the machine. The new rate of depreciation is based on revised useful life of 15 years. The new rate shall apply with retrospective effect from 1/4/2009. State how would you deal with the above in the annual accounts of the company for the year ended 31st March 2013 in the light of AS5.
Once again, the new rate should apply with retrospective effect from 1/4/2009 is old answer. Old answer. Don't follow this. Don't follow this. There is a new question based on same concept. I'll tell you. 1 second. I think I changed this. I changed the answer. This is the old answer. In LO, it is there. No, this is the answer given in ICI study material. This table is there. No, this I prepared. So the answer is correct. This cannot be asked by ICI now. ICI, sorry, you are not supposed to ask this now. So it should be prospective accounting. Now tell me what is the cost of the asset? 5 lakhs, correct? And estimated useful life 10 years. Machine is expected to realize 50,000. So 5 lakhs minus 50,000 divided by 10 years. What is the amount of depreciation? Can you tell me? Hello, amount of depreciation chahiye. Hey, why are you? Tell me answer. 45,000. Correct. Correct. How many years you used it? How many years you used it?
10 years.
No. 10 years is total life, ma. You bought it on 1/4/2009. You used it up to 2012. 2012, yeah, 9. 10, 11, 12. 3 years you used, that's all. For 3 years, tell me what is accumulated depreciation?
1,35,000.
Very good. 1,35,000. Correct. So now tell me what is the WDV today? 5 lakhs minus 1,35,000. So can I say it is 3,65,000? From today onwards, you charge 15% on 3,65,000. That's all. So take 3,65,000, apply 15%. So 54,750. That's all. This is the depreciation. So this is old answer. I have deleted it and I have given you new answer. This is the correct. Are we clear? Can we move on? Okay. AS7, comparatively a very simple standard. There is only two categories of problems given. One is in the drama of ICI, in reality, all real estate agents, contractors, builders are making money. Only in ICI drama, like Ekta Kapoor serial, always this contractor will be in loss. Why the hell this contractor will be in loss? And in partnership, why partner C is always in loss? God knows. So there, partner C cries every time. Partner C is one crying face. He is born crying, he will die crying. Okay, in ICI books also, here all the contractors are incurring losses. So ICI cannot see any contractor who's in profit. So what we need to do is, we need to create a provision for loss, which is against normal accounting. Okay, so in contract accounting, what we do is we have something called recognition of revenue to the extent of contract work done. Someone is saying in chat that is because ICI is innocent and does not take black money into account, sir. Yeah, maybe yes. Okay, no discussion about black money in ICI class. Even in our personal class, also no discussion about black money. Chalo, anyway. So here what we need to do is, step one, we need to calculate percentage completion. How do we calculate percentage completion? There are three methods. One is called cost to cost method. Yes, one is called cost to cost method. Second one is called technical surveyor method. Third one is called physical unit method. Pawan sir, what is that? Cost to cost method is cost incurred till date plus estimated cost to complete the contract divided by total cost of the contract. That means simple. Till today, what you have done? Pawan sir, till today, I have spent 60 crores. Okay. How much more you think is required to complete the contract? Pawan sir, another 25 crores is required to complete the contract. Okay. Then what is your total cost? 60 plus 25. So today you incurred 60 divided by total cost is 60 plus 25. So 60 by 85 will be your percentage completion. This is one method which is used only for the purpose of CA intermediate accounting exam. In reality, no one does that. I have done enough audits, enough accounting and financial reporting for construction contracts. Okay. Whoever he is, small or big, they will go with technical survey. They will hire one engineer. Engineer will tell 82.5% of contract is complete. I will recognize 82.5% revenue. As simple as this. I will not go and see out of 1,25,000 bricks, how many bricks I have put, out of 45 tons of bags, how many bags I have put. Idiot also will not count like that. But if that is accounting, life of student is simple. If ICI says technical surveyor has given certificate for 82.5%, everything is done. Now you take contract price into 82.5%, recognition of revenue is over. ICI doesn't want that. So they assume the world is going with first method, which is practically wrong, which is wrong. But they'll do, you have to do problem like that only. We don't know. ICI will tell, no, I want you to do problem like this. That's all. Sir, second method, which is no. Third method, physical number, no, we don't. So we'll do only first method. So you should know how to calculate that bloody percentage. Cost incurred till date divided by cost incurred till date plus estimated future cost. That percentage you have to apply. When you apply that percentage, another drama is the contract will be 1,000 rupees. For example, already you incurred 1,000 rupees contract. Already you incurred 800. Okay. And you will incur another 350. But Pavan sir, for 1,000 rupees contract, already I incurred 800. I'll incur another 350. Total 1,150. 150 loss. What to do? Create a provision for loss. That's all. That is what the drama will be. Another category of questions can be, we'll do this. Another category of question can be substance over form. 4 contracts, clubbing them into one. One contract, dividing it into 4. That means there are 4 contracts, but for the purpose of accounting, we club all the 4, combining of the contracts into one. Another way is there is only one contract, but segmentation. For the purpose of accounting, we treat them to be 4 contracts. These 2 are the areas where questions are asked. 90% first category of question, 10% that theory question. Okay, so we'll do one exhaustive problem which covers all the concepts and an excellent one. Then we'll say 2 problems, we'll do 2 problems. Okay, so can someone read problem number 3? Sai Sumi, can you read problem number 3, please? Anyone? Can someone read question number 3, please? Make it fast. Naveen, can you read the question?
Yes, sir. Show profit and loss account extract in the books of contract of a contractor in respect of the following data. Amount in thousands. Contract price fixed cost 600. Incurred to date 390. Estimated cost to complete 260.
Wait. So till today 390 he incurred. Okay. To complete the contract, another 260 is required. Okay. So what is total cost to complete? 390 plus 260. How much it is?
Yes, sir. 860, sir.
Right. 390 plus 260, right?
650.
100 people told in the chat. After that, you realized 650. 390 plus 260, 650. So your contract price is 600. Your selling price is 600. Cost price is 650. Is it profit or loss?
Loss.
How much?
50.
Is it total loss for the contract or loss for the current year?
Total loss.
Very good. Total
loss for the current year.
No. Listen. So, this is contract price. How much? 600. In that, cost incurred already. So this is current year. Current year, how much cost incurred? Current year, how much cost incurred? They said current year cost incurred till date is 390. 390. Okay. In future, estimated further cost to complete the balance part of the contract is 260. This is what they told. So what is total cost? Total cost is this plus this. So total cost is 650. Now profit. Profit is sales minus cost. Oh, minus 50 loss. So is it current year loss or total loss? It is total loss. Total loss minus 50. Okay. Now, as per accounting standard 7, what is the revenue recognized? Revenue recognized as per AS 7 is equal to total contract price into percentage completion. Now I'll calculate percentage completion. Percentage completion is 390 divided by 650 into 100. 390 till to date, 650 total. So my percentage completion is equal to, 390 divided by 650 into 100. How much it is?
60%. 60.
No, it should be 65%. Is it 60 or 390 divided by 650, ma? I don't know. 390 divided by 650. 60%. 60 only. 60. Someone is saying 65. I don't know. In the chat box, someone said 65%. It should be 60. Hey, if you tell 65, probably you have taken ratio of 390 divided by 600, which is wrong. It is cost to cost formula. I did not say cost to selling price. Cost to cost formula. You remember? So it is 60%. Now revenue recognized how much for current year? Total 600 into 60%. That is 360. Yeah. That is 360. So this is current year. Cost recognized for current year. How much given? Cost till date 390. Oh my God. So current year loss, how much?
30.
Current year loss 30. But Bhavan sir, 30 rupees I already lost. But I know that I will be losing a total 50. So how much more I might lose? 20. For that 20, create a provision. Some student is asking in the chat, sir, when we know the total cost is 50, what is the purpose of calculating this 30? Simple. Saying that this 30 already I suffered, this 20 in future, I am expecting that I lose another 20. You need to clearly distinct these two numbers and show 30 actual loss, 20 provision for future loss. Provision for future losses shall never be made in accounting. AS7 is an exception. Provision for future losses can never be made. AS7 is exception. So guys, this is the problem. Are we done? Okay, look here. If you prepare contract account by revenue 360, to contract cost 390, by net loss 50, provision for loss 20. This is how we write contract account. That's it. You understand? So total net loss is 50. Out of that, provision is 20. That means 30 is actual loss. 20 is expected, estimated loss. That's all. Okay. Now, there is something called, Deepak is asking, okay, sir. So we just have to record 30 lakhs. No, you have to record all the 50. 30 will be current year loss, 20 will be future loss. Total loss recorded in balance sheet should be 50 in P&L. Total loss in P&L should be. Sir, are we discussing AS 5 or 7? Average 5 plus 7 by 2, 6. AS 6 is there? No, that died long back. AS 6 died long back. Now we are dealing with 7. Okay. Chalo, can someone read this for me? Can someone read this, please?
When a
Read
con-
that. Okay.
Great.
Let her read. Okay.
When a contract covers a number of assets, the construction of each asset should be treated as a separate construction contract when separate proposals have been submitted for each asset. Each asset has been subject to separate negotiation, and the contractor and the customer have been able to accept or reject that part of the contract relating to each asset, and the cost and revenue of each asset can be identified. A group of contracts, whether with a single customer or with several customers, should be treated as a single construction contract when the group of contract is negotiated as a single package. The contracts are so closely interrelated that they are, in effect, part of a single project with an overall profit margin, and the contracts are performed concurrently or in a continuous sequence.
So I'll give you a simple small example. Okay, to understand this concept, I'll give you a small example. Imagine I am a contractor, interior designer. Okay, there is one apartment with 20 flats. Okay, one flat is owned by Deepak, one flat is owned by Naveen, one flat is owned by Ashima, one flat is owned by someone else. So like that, 20 flats have 20 different owners. Okay, so one fine day, one of the flat owners called Pavan to the site. Pavan came and he said, okay, this is the house. Okay, I'll take 6 lakh rupees for interior. I said, I'll take 6 lakh rupees for the interior. Then what this girl did, you know? Hey, Pavan, sit here, have coffee. Okay, I'll come in 2 minutes. Then she went to next flat and said, hey, listen, one nice interior designer came. He's telling 6 lakhs. Do you need interior designer? The other flat guy said, yeah, even I need interior designer. 6 lakhs is quite cheap. So shall we go and negotiate together? You come. And then 4 remaining people came and said, hey, even we are looking for interior designer. All the 6 will go and negotiate with Pavan. So within 2 minutes, this side 1 party, that side 6 parties. So all of them said, hey, Pavan, do it for 5 lakhs per person. Okay. Take wholesale contract. All this, you know, the whole apartment, floor number 2, 6 flats, you do it. Same specifications. We don't change specifications and all, you do it. So for the purpose of legality, I entered into contract with the 6 people separately, 6 contracts, 1 interior designing contract with Naveen, 1 interior designer contract with someone else, 1 interior designing contract with someone else, like that, 6 people, 6 contracts. But same price, I am starting on same date, I am ending on same date, and accepting or rejecting of 1 flat will influence on the remaining 5 flats also. If I'm saying no to 1, I'm saying no to 6. If I'm saying yes to 1, I'm saying yes to 6. So 6 legal contracts, but actually don't you think for the purpose of accounting, it is 1 contract for contractor. Accounting for contractor. It is not accounting for contractee. Accounting standard 7 doesn't deal with accounting for contractee. Accounting for contractee, go to AS10 property, plant and equipment. Yeah, correct. You are constructing an asset. Capital work in progress. You follow accounting standard 10. I am a contractor. I follow accounting standard 7 because for you it is asset. For me it is revenue. Eh? Correct. For you it is asset. For me it is revenue. Accounting standard 7 is revenue recognition standard. So 6 contracts for accounting purpose, 1 account. I will write in my books of account like this. Interior designing, 2nd floor, Annapurna Towers, Chennai. 1 contract for me. But Pavan sir, legally you entered into 6 contracts. No, for accounting, there is only 1 contract. You understand? This is what we call combining contracts. This is what we call combining contracts. Now, on the other hand, I have accepted 1 contract for a township. Separate biddings, 1 contract is not influencing the other contracts. Out of 4 works, I might undertake 1, or I might undertake 2, or I might undertake 3, or I might undertake 4. The township owners, they called me and said, Pavan, you have to construct one apartment for us. Okay. Residential tower here. Okay. It's playground here. Okay. Swimming pool here. Okay. One helipad. We are rich people. We have, chartered flights, helicopter. Okay. And you have to construct one cinema theater there. Okay. So they asked for construction of cinema theater, how much you take? I gave my quotation. For swimming pool, how much you take? I gave my quotation. Helipad, I gave my quotation. Electric work, I gave my quotation. Plumbing work, I gave my quotation. Residential tower, I gave my quotation. Petrol pump you need to put here. I gave my quotation. They are happy and they said, Pavan, do one thing. All the 7 contracts to you. Single stamp paper. So they bought one stamp paper and they said that Annapurna Constructions and Pavan entered into contract to construct asset 1, asset 2, asset 3, asset 4, asset 5, asset 6, asset 7. Single contract. But for the purpose of accounting, all the 7 will not start on same day. All the 7 will not end on same day. Acceptance and rejection of one asset will not influence my other business. So though there are group of assets to be constructed by me, in one legal contract, for the purpose of accounting, there are 7 different contracts because percentage completion of asset 1, percentage completion of asset 2 could substantially differ. On 31st March 2023, asset 1, which is a residential unit, 72% complete, and I have not even started playground. 0. So how can you combine these two to do accounting? That is 72% completed asset, separately recorded. 0% completed, separately recorded. That is the reason this is single contract. Legally cut it into different contracts for accounting purpose. That's all. Now there is one problem. I do not remember whether it is there here. There is something called Shyam Construction, Shyam Limited Bolke. There should be one exam. Shyam aa gaya. How many times we taught this? Deepak, can you read problem number 4?
Yes, sir, I'll read, sir. I'll read.
One more Shyam will come in accounting standard 9. This is first Shyam.
Okay, sir. So, Mr. Shyam, a construction contractor undertakes the construction of an industrial complex. He has a separate proposals raised for each unit to be constructed in the industrial complex. Since each unit is subject to separate negotiation, he is liable to identify the cost and revenue attributes to each unit. Should Mr. Shyam treat construction of each unit as a separate construction contract according to AS7?
So tell me the answer. So if you look at the answer, first they have given theory. Separate proposals have been submitted. Okay. Each asset has been subject to separate negotiation. Okay. Contractor and customers have been able to accept or reject any part of the contract. Okay. Cost and revenue of each asset can be identified separately. Okay. Now you tell me whether they should be separate contracts or all of them put together one sambar. We'll make 4 different curries or one sambar. Separate. Clearly, there are separate contracts. That's it. That's it. So you can do one more problem, this problem. Okay, Vishwakarma. This is also previously asked question. I see a study material question. So can you read this problem, Deepak? After this, we'll take a small break. 3 standards completed. After break, we'll try to cover another 3 standards or more.
Okay, sir. Yes, sir. On 1st December 2014, Vishwakarma Constructions Company Limited undertook a contract to construct a building for rupees 85 lakhs.
So this 85 lakhs, do you think it is selling price or cost price? 85 lakhs is selling price.
Agreed.
Continue.
Maybe it is agreed value, sir.
Yes, contract price is always selling price.
Okay. On 31st March 2015, the company found that it had already spent rupees 64,99,000 on the construction. Prudent estimate Prudent estimate of additional cost of completion was rupees 32 lakh 1000.
Now,
Calculate
can
the
you
total
add these two numbers, all of you, and can you tell me what will be the total cost to complete contract? Total cost to complete contract, 65 plus 32, 65, 75, 85, 95, 96, 97. Is it 97 lakhs?
97 lakhs, yes, sir. 97
Ah,
lakhs.
but your selling price is 85 only, but you are incurring 97 lakhs. Is there a loss?
Yes, sir.
How much?
12 lakhs.
12 lakhs loss. Okay. Now, can you calculate the percentage completion? It is 64 lakhs 99,000 divided by 97 lakhs. So it is 67%.
67%.
Now,
Yes, sir.
calculate 67% of 85 lakhs. 85 lakhs into 67%, how much?
56 lakh 95,000.
56 lakhs 95,000. So that 56 lakhs 95,000 is the revenue that can be recognized for this year, whereas 64 lakhs 99,000 is the cost already incurred. So current year loss is 56 lakhs 95,000 minus 64 lakhs 99,000.
8 lakh 4,000.
How much it is?
8 lakh 4,000.
8 lakh 4,000. Total 12 lakhs. Out of that 8 lakh 4 lakhs, if you take, is it 3 lakhs 96,000?
Yes, sir.
That 3 lakh 96,000 will be provision for loss. Future. That's all. Look at the problem. Fadafat, are we done?
Same answer. Yes, sir.
Okay. We'll take a small 10 minutes break. We'll take a 10 minutes break. What is the time? Time.
35, sir. 8:35.
8:35. We'll come back by 8:45. Okay. Same meeting. I'm not closing the meeting. Just audio mute, video mute. I'll come back by 8:45. 10 minutes sharp. Okay.